The first bank failure of 2026. On January 13th, federal regulators walked into a Chicago bank, locked the doors, and by Monday morning the name on the building had changed. No long lines, no shouting crowds, just silence. But here's the part no one is talking about. This bank survived 2008. It survived the pandemic. It survived everything. Until now. Why did it fail in 2026? Why are regulators moving faster than ever before? And why are analysts quietly watching other regional banks right now? Very closely? This wasn't just a closure. It may have been the first signal, and the next one could matter far more than anyone expects. Welcome. If you value calm, clear thinking in uncertain times, take a moment and consider subscribing, not out of panic, but out of preparation, especially if you've worked hard your whole life and want to protect what you've built. And before we begin, tell me in the comments, where are you watching from today? City and country, I read every single one. The signal beneath the surface, what the new data actually shows. The headline moved quickly across financial terminals. Analysts did not shout, they did not panic, but they paused. The new data did not scream crisis, it whispered pressure. And for those who study economic cycles, whispers often matter more than noise. The update showed a pattern that had been building quietly for months. Regional banks reported higher loan loss provisions. Commercial real estate delinquencies ticked upward again. Net interest margins tightened. Deposits continued to shift toward the largest institutions. None of these figures alone signaled collapse. Together, however, they formed a consistent message. Stress was spreading beneath the surface. He, the careful business owner reviewing the numbers late at night, noticed something familiar. The pattern resembled early 2023, but this time the pressure appeared slower and broader. It was not concentrated in one niche. It was structural. The numbers suggested that smaller and mid-sized banks were still absorbing the delayed impact of interest rate hikes that began nearly 2 years earlier. The Federal Reserve's rate increases were designed to slow inflation. They did exactly that. But monetary policy works with a lag. Economists often describe this lag as 18 to 24 months. When rates rise sharply, borrowers feel little immediate pain. Existing loans continue under old terms. Only when refinancing begins does the pressure become visible. That window is now open. The new report showed that commercial real estate delinquency rates had climbed to their highest level in nearly a decade. Office properties in major cities continued to struggle with occupancy. Retail spaces faced reduced foot traffic. Multifamily housing faced higher financing costs. For banks heavily exposed to these sectors, balance sheets were tightening. She, the regional bank executive reviewing quarterly results, understood the arithmetic. And when a borrower who once paid 3% must refinance at 8%, the math changes quickly. Cash flow becomes thinner. Margins shrink. Some projects become unviable. When those loans begin to show strain, banks must increase reserves. Increasing reserves reduces reported earnings. Lower earnings weaken capital buffers. The process is mechanical. It does not require drama. The data also showed deposit movement continuing toward large national banks and money market funds. Higher treasury yields offered safe alternatives. For depositors, the decision was rational. For smaller banks, it meant higher funding costs. To retain deposits, they had to pay more. Yet many of their loans were issued when rates were far lower. Income rose slowly, costs rose quickly. That gap narrowed profitability. They, the analysts tracking regional bank spreads, observed widening differences between large and small institutions. Credit markets were pricing in more caution for mid-tier banks. Equity valuations reflected uncertainty. Again, this was not panic, it was repricing. The pattern reminded experienced observers of prior cycles. In past tightening environments, stress rarely appeared at once. It began with margin compression. It continued with selective defaults. It accelerated when refinancing walls approached. The new data suggested that the refinancing phase had begun. Business leaders watching these trends understood that banks are not isolated from the real economy. When banks feel pressure, lending standards tighten. When lending tightens, expansion slows. The chain reaction moves gradually, but it moves consistently. The data further revealed that loan-to-deposit ratios were rising in several regional institutions. A higher ratio can signal efficient capital use, but it can also indicate thinner liquidity cushions. In a stable environment, that balance may be manageable. In a stressed environment, it narrows flexibility. He, the founder planning a new warehouse expansion, noticed that financing conversations had changed tone. Banks asked for more documentation. They requested higher collateral coverage. They discussed risk in more detail. No one said crisis. Yet the mood was cautious. What made the update significant was not a single alarming number. It was convergence. Commercial real estate weakness, deposit migration, margin compression, reserve increases, all aligned within the same quarter. That alignment tends to precede broader tightening cycles. The concept of the lag effect deserves careful attention. When interest rates rose sharply in 2023 and 2024, banks appeared stable. Earnings remained solid. Credit losses were limited. Many observers assumed resilience, but resilience during the early phase of tightening does not guarantee resilience during refinancing. Now, approximately 2 years later, many loans written in low-rate environments are reaching maturity. Borrowers must refinance under higher rates and lower property valuations. If valuations have fallen 25%, equity cushions shrink. If rates have doubled, debt service burdens rise. The pressure shifts from a theoretical to immediate. She, the commercial property owner preparing to refinance, confronted this reality directly. A building once valued at $10 million might now appraise closer to $7 million. Lenders demand lower loan-to-value ratios. That gap must be filled with fresh capital. In tighter markets, that capital is difficult to raise. For banks holding large volumes of such loans, the challenge becomes systemic rather than isolated. Even modest increases in defaults require greater reserves. Greater reserves reduce earnings. Reduced earnings weaken stock prices. Lower stock prices limit access to new capital. The cycle reinforces itself. It is important to note what the data does not show. It does not show widespread bank insolvency. It does not show immediate failure. It does not show frozen credit markets. Instead, it shows early strain indicators rising together. Historically, that combination signals caution. They, the disciplined entrepreneurs observing the data, recognize that credit conditions often change before headlines confirm them. By the time public narratives turn negative, lending standards have already tightened. Preparation must precede confirmation. Another notable data point was the increase in unrealized losses on certain bank bond portfolios. Although many banks held long-term securities purchased during low-rate periods, higher yields reduced the market value of those holdings. While these losses may not immediately impact regulatory capital if held to maturity, they reduce flexibility in liquidity management. If forced to sell, losses become realized. The bond market also reflected subtle warning signals. Spreads on regional bank debt widened modestly. Investors demanded slightly higher compensation for perceived risk. Again, not panic, but caution. He, the investor analyzing fixed income markets, understands that bond investors often detect stress earlier than equity markets. Bond spreads respond to balance sheet concerns before share prices fully reflect them. The broader economic backdrop adds complexity. Inflation has cooled but remains present. The Federal Reserve faces limited room to cut rates aggressively without reigniting price pressures. That constraint limits the speed at which relief can arrive for banks facing refinancing strain. For business leaders, the implication is strategic rather than emotional. They must assess liquidity positions. They must evaluate exposure to specific banks. They must understand how tightening credit could affect payroll, expansion, or inventory financing. The new data, therefore, serves as a signal, not a verdict. It suggests that 2026 may test regional banking resilience more severely than the previous year. It suggests that delayed consequences of prior rate hikes are entering the visible phase. Calm analysis remains essential. Panic distorts decision-making. However, ignoring early signals carries its own risk. The most disciplined operators treat such data as an opportunity to strengthen balance sheets, diversify relationships, and increase financial flexibility. In economic cycles, the earliest warnings are rarely dramatic. They appear as clusters of modest shifts. The current cluster deserves attention. Part 1 closes not with alarm, but with recognition. The data indicates mounting structural pressure. For those who depend on stable credit conditions, understanding this shift may prove decisive in the months ahead. The pressure point: commercial real estate and the refinancing wall. The real danger was not sitting in headlines. It was sitting in spreadsheets. Behind the calm tone of quarterly earnings calls, a far more serious issue was forming. It was not new. It had been building slowly for 2 years. But now it was approaching a wall, and walls in finance are rarely soft. They call it the refinancing wall. Between 2026 and 2027, nearly $2 trillion in commercial real estate debt is scheduled to mature in the United States. That number does not appear dramatic at first glance. The system is large, the economy is resilient, but the structure of that debt tells a different story. Much of it was written when interest rates were near historic lows. Loans were priced at 2, 3, sometimes 4%. Property values were elevated. Occupancy assumptions were optimistic. Capital was abundant. Risk appeared manageable. That world no longer exists. Now, many of those same loans must be refinanced at rates closer to 7, 8, even 9%. At the same time, property valuations in the certain office and retail markets have fallen between 25 and 40%. The math does not bend. It breaks. He, the commercial borrower preparing to refinance a downtown office building, studies the updated appraisal. The building, once valued at $10 million, is now estimated closer to $6.5 million. The lender will not refinance the original loan amount. The bank demands lower leverage. The borrower must inject new equity. But new equity is expensive. Investors are cautious. Cash is selective, and some borrowers simply cannot fill the gap. When that gap cannot be filled, keys are handed back, quietly, professionally, but permanently. For regional banks, this is where suspense becomes reality. Unlike national giants with diversified portfolios, many smaller banks carry heavy exposure to commercial real estate. In some cases, more than 30% of their loan book is tied to this sector. In certain markets, the percentage is even higher. She, the risk officer inside a mid-sized bank, reviews internal stress tests, rising vacancy rates, higher cap rates, slower leasing velocity. Each variable shifts projections downward. Loss scenarios that once looked theoretical begin to move closer to base case assumptions. The most dangerous element is not a sudden collapse. It is gradual erosion. Banks have been managing this risk through a strategy commonly described as extend and pretend. When a borrower struggles, instead of declaring default, the bank extends the maturity. It restructures the terms. It delays recognition of loss. This approach buys time. It avoids immediate damage to capital ratios, but time is not infinite. As more loans reach maturity simultaneously, extensions become harder to justify. Regulators have grown less tolerant. They are asking sharper questions. They are examining asset valuations more closely, and they are pushing banks to mark certain assets closer to market reality. When that happens, capital shrinks quickly. They, the analysts studying regulatory filings, notice loan loss provisions rising across multiple regional institutions. Not dramatically, but steadily. That steady climb is what demands attention. Consider the arithmetic from a business perspective. If a bank holds $1 billion in commercial real estate loans and even 10% of those loans require meaningful restructuring, the impact can be significant. Write-downs reduce capital. Reduced capital limits new lending. Reduced lending tightens credit for the broader economy. The cycle feeds itself. He, the entrepreneur seeking financing for expansion, senses this shift before he sees it reported. Loan officers request additional guarantees. Approval timelines stretch. Terms become less favorable. The conversation changes from growth to risk management. The suspense lies not in whether refinancing pressure exists. It lies in how deep it runs. Office properties remain the most visible weakness. Remote work trends have permanently altered demand in certain cities. Large towers that once commanded premium rents now struggle with occupancy. But retail properties face pressure from changing consumer behavior. Industrial properties face rising financing costs. Even multifamily housing, often considered resilient, must confront higher debt service burdens. The refinancing wall does not discriminate. She, the portfolio manager evaluating bank stocks, recognizes that market valuations are adjusting accordingly. Regional banks with concentrated commercial exposure trade at lower multiples. Investors are pricing in uncertainty. Yet uncertainty does not equal inevitability. The system is not collapsing, but it is recalibrating under pressure. Another element intensifies the suspense: liquidity. If a bank anticipates potential losses, it conserves cash. It slows lending. It tightens underwriting standards. That conservative stance protects the bank but restricts economic activity. When enough institutions behave this way simultaneously, the effect becomes macroeconomic. The numbers illustrate the challenge clearly. Loans originated at 3% now require refinancing at nearly triple that rate. A property generating stable rent may still become unviable under higher debt costs. Even well-managed assets can face distress when interest burdens exceed cash flow capacity. This is not about reckless lending alone. It is about structural transition from a low-rate era to a higher-rate equilibrium. They, the seasoned business operators, understand that transitions create both risk and opportunity. Distressed assets may become available at discounts, but liquidity is required to capture those opportunities. The key question remains, how concentrated is the exposure? Regulatory data suggests that smaller banks hold a disproportionate share of commercial real estate loans relative to their capital base. That imbalance amplifies vulnerability. If property values recover quickly, stress may ease. If refinancing markets remain tight, pressure may intensify. Suspense in finance rarely comes with dramatic music. It arrives through maturity schedules. It arrives through appraisal revisions. It arrives through incremental reserve increases. The refinancing wall is approaching, not as a sudden crash, but as a test of balance sheet resilience. For entrepreneurs and business leaders, this means preparation. They must evaluate their lenders. They must understand which institutions carry heavy commercial exposure. They must anticipate tighter credit conditions and plan liquidity accordingly. Part 2 concludes with a disciplined observation. The arithmetic behind commercial real estate refinancing is becoming less forgiving. The wall is visible. Whether institutions absorb the impact smoothly or stumble will define the next phase of 2026. The behavioral shift, deposit flight, and the silent liquidity drain. The true threat was not only sitting inside loan portfolios, it was moving quietly through mobile banking apps. Modern banking stress no longer begins with crowds outside branches. It begins with a notification, a headline, a subtle change in tone, and then without sound, money moves. They call it deposit flight. It does not require panic. It does not require fear. It requires only logic. When Treasury bills offer attractive yields and large national banks appear safer, rational depositors reallocate. A few clicks, a wire transfer, a portfolio adjustment. For a regional bank, even small outflows matter. He, the treasurer of a mid-sized manufacturing company, reviews cash balances. His operating account holds several $1,000,000. Insurance limits cover only a fraction. He remembers recent headlines. He shifts a portion to a larger institution. It feels prudent. It feels responsible. Multiply that decision across thousands of businesses. The balance sheet begins to tighten. Deposits are the foundation of bank liquidity. They fund loans. They anchor stability. When deposits drift away, banks must respond. They can raise rates to attract new funds, but higher deposit rates compress margins further, or they can borrow from wholesale markets. But wholesale funding is more expensive and more sensitive to market sentiment. She, the chief financial officer of a regional bank, notices the trend in daily liquidity reports. Outflows are not dramatic. They are steady, predictable, yet persistent. The suspense lies in the pace. In earlier decades, deposit shifts took time. Customers had to visit branches. They had to wait in lines. Information traveled slowly. Today, digital infrastructure compresses reaction time. Capital reallocates in minutes. Markets understand this speed. Bond investors respond first. Spreads on regional bank debt widen slightly. Analysts adjust liquidity stress scenarios. Equity markets follow with modest volatility. Nothing explosive, but tension increases. They, the experienced market observers, recognize that confidence is not binary. It erodes gradually. A single failure does not cause systemic collapse. But repeated signals reduce tolerance for risk. Deposit flight has another dimension: concentration. Large national banks benefit from perceived stability. Government backstops are implicitly stronger. Scale provides comfort. In uncertain environments, size attracts liquidity. This dynamic accelerates consolidation. Smaller banks, already managing refinancing pressure, now face higher funding costs. To remain competitive, they increase deposit rates. That reduces net interest margins further. Lower margins reduce earnings. Reduced earnings weaken investor confidence. The cycle tightens. He, the entrepreneur negotiating a credit line renewal, senses a shift. The bank officer explains that liquidity is being preserved. Lending standards are under review. Approval requires additional scrutiny. The connection becomes clear. Deposit movement alters lending capacity. Liquidity risk differs from solvency risk. A bank may be fundamentally solvent yet vulnerable if deposits move too quickly. That vulnerability creates the need for defensive positioning. The Federal Reserve provides liquidity facilities. Discount windows remain available. Emergency programs can be activated. But reliance on such facilities carries reputational cost. Markets monitor usage closely. She, the regional bank CEO, understands this perception. Accessing emergency funding may stabilize operations. It may also signal weakness. Communication becomes delicate. Behavioral economics plays a decisive role. When business owners hear of one institution experiencing stress, they reassess their own exposure. Even without direct evidence, precaution drives action. They, the disciplined entrepreneurs, adjust treasury strategies. They diversify across institutions. They stagger maturities. They hold short-term government securities. None of these moves indicate panic. They indicate awareness. Yet awareness itself shifts liquidity patterns. Digital banking intensifies the dynamic. Transfers that once required paperwork now require seconds. Large balances move seamlessly. There is no visible line outside the branch. The drain is invisible. This is the silent liquidity shift. Suspense deepens when liquidity outflows intersect with refinancing stress. If a bank must reserve capital against potential loan losses while simultaneously managing deposit attrition, flexibility narrows. The bond market senses this narrowing. Yield spreads on certain regional banks widen again. Analysts revise liquidity coverage ratio projections. Market participants speak in measured tones. No alarm, but no complacency. Confidence remains the invisible variable. He, the investor evaluating regional bank stocks, observes price volatility increase modestly, not collapse. Adjustment. Market pricing reflects probability distributions, not certainty. The psychological dimension cannot be overstated. Banking functions on trust. Depositors trust that funds remain accessible. Borrowers trust that credit remains available. Investors trust that balance sheets remain transparent. When trust weakens slightly, behavior shifts incrementally. Incremental shifts compound. Deposit flight does not require mass hysteria. It requires rational optimization, higher yields elsewhere, perceived safety in size, diversification of risk. The suspense in 2026 lies in whether this migration stabilizes or accelerates. If outflows remain manageable, banks adapt. They adjust pricing. They strengthen liquidity buffers. They navigate the cycle. If migration accelerates, pressure multiplies. For business leaders, the strategic implication is clear. Liquidity planning becomes essential. Treasury management moves from routine function to strategic priority. Concentration risk must be evaluated deliberately. She, the founder of a growing logistics company, decides to maintain relationships with multiple institutions. She splits operating funds. She reviews insurance coverage carefully. She monitors credit conditions quarterly. These actions are defensive, not dramatic. But in tightening cycles, defense preserves optionality. Part 3 concludes with a calm but firm observation. Liquidity dynamics in 2026 are evolving faster than in previous cycles. Digital banking has compressed reaction time. Deposit migration is rational. Regional banks must manage both refinancing stress and funding stability simultaneously. The suspense does not revolve around immediate collapse. It revolves around resilience under sustained pressure. The strategic inflection point. What 2026 demands from business leaders? The numbers were no longer isolated signals. They were converging forces. Refinancing pressure, margin compression, deposit migration, liquidity tightening. Individually, each force could be managed. Together, they form an inflection point. 2026 is not shaping into a dramatic collapse scenario. It is shaping into a discipline test. He, the founder preparing his annual growth plan, senses that the environment has changed. In 2021, expansion was funded easily. In 2022, capital was abundant. In 2023, caution appeared. By 2026, the tone has shifted decisively toward control and preservation. The question facing every serious operator is simple. What does tightening credit mean for real-world execution? When banks face capital pressure, they lend less aggressively. That is not theory. It is policy. Risk committees tighten underwriting standards. Loan-to-value ratios fall. Personal guarantees become common. Covenants grow stricter. Growth slows, not because demand disappears, but because financing becomes selective. She, the owner of a regional construction firm, notices project financing approvals stretching longer. Developers hesitate. Private equity firms demand higher returns. Insurance premiums climb. The friction is subtle yet constant. This is how a credit cycle tightens. The suspense lies not in whether credit will disappear entirely. It lies in who receives it. Large corporations with diversified revenue streams and strong collateral profiles will continue to access capital. Smaller firms, dependent on local banking relationships, may encounter obstacles. The difference widens. This dynamic accelerates consolidation. When small institutions tighten lending, large institutions fill only selective gaps. The result is not equal redistribution. It is concentration. The strongest businesses survive and absorb market share. The unprepared face compression. They, the disciplined entrepreneurs, recognize that preparation now determines positioning later. Liquidity becomes leverage. A company holding sufficient cash reserves gains negotiating power. It can secure inventory at discounts. It can acquire distressed competitors. It can maintain payroll while others cut. But liquidity must be intentional. It cannot be reactive. He, the founder who once prioritized maximum leverage for rapid expansion, reconsiders his capital structure. Debt that seemed efficient in low-rate years now carries higher rollover risk. Refinancing assumptions are no longer guaranteed. The strategic shift is subtle but critical. Preservation of capital becomes equal to pursuit of growth. Market participants are already repositioning. Institutional investors are reallocating toward short-duration assets. Treasury yields remain attractive. Cash equivalents offer safety and flexibility. Regional bank equities trade cautiously. The bond market, often underestimated by entrepreneurs, sends early signals. Widening spreads suggest increased credit risk pricing. Investors are demanding compensation for uncertainty. This is not fear, it is repricing. She, the CFO of a mid-sized technology firm, begins scenario modeling. What happens if credit availability declines by 20%? What if refinancing costs rise another 150 basis points? What if customer demand softens as lending tightens? Strategic operators do not predict collapse. They stress test assumptions. The broader macro environment compounds complexity. Inflation remains present enough to limit aggressive rate cuts. Central banks cannot fully reverse tightening without risking renewed price instability. That constraint reduces the likelihood of immediate relief for stressed balance sheets. This is the central tension of 2026. If rates remain elevated, refinancing pressure intensifies. If rates fall sharply, inflation expectations reawaken. Policymakers must navigate carefully. They, the serious decision makers, must assume that policy support may arrive slowly and selectively. One of the most underappreciated consequences of tightening cycles is opportunity concentration. Distressed asset markets expand. Valuations compress. Businesses with clean balance sheets gain negotiating advantage. However, entering such opportunities prematurely can be dangerous. Timing requires discipline. He, the private investor, scanning distressed commercial real estate listings, recognizes that price reductions may not yet reflect full refinancing adjustments. Patience may yield stronger positioning later. Strategic patience becomes an asset. Another dimension emerges: labor markets. As credit tightens and expansion slows, hiring momentum softens. Businesses reduce discretionary projects. Capital expenditures are postponed. The ripple effects extend beyond finance into operations. This is how financial tightening translates into economic moderation. Yet moderation does not equal collapse. The environment demands clarity. She, the operator who built her business over 2 decades, understands that cycles are inevitable. What distinguishes resilience is not optimism, it is preparation. Preparation involves diversified banking relationships. It involves reviewing loan covenants. It involves understanding deposit insurance structures. It involves maintaining multiple liquidity channels. The digital acceleration of liquidity movement reinforces this necessity. Treasury management cannot rely on assumptions. It must rely on structure. The suspense in 2026 is defined by structure. Will refinancing pressures peak and stabilize, or will deposit migration accelerate beyond manageable thresholds? Will regional banks adapt efficiently, or will consolidation accelerate rapidly? The answers remain uncertain. But the strategic response is clear. Defensive positioning does not imply retreat. It implies discipline. They, the disciplined entrepreneurs and investors, recognize that survival during tightening cycles often precedes expansion during recovery. When competitors overextend, those with balance sheet strength inherit opportunity. Part 4 closes with a measured conclusion. 2026 is emerging as a year of recalibration rather than catastrophe. The warning signals are real. The data warrants attention, but decisive advantage belongs to those who interpret signals early and adjust methodically. In financial history, inflection points reward preparation. The environment ahead will test liquidity, patience, and strategic clarity. Those who treat the current signals as background noise may find themselves reacting. Those who treat them as strategic guidance may find themselves leading.